What is clear to me, because I have been listening carefully to the Treasury Secretary and the President, is that they see tariffs as a way of raising revenues, and they have a very aggressive revenue target for tariffs. They want to raise hundreds of billions, $300 billion a year in tariff revenues, which is an order of magnitude larger than what we have seen recently. And that means that tariff rates have to be at those high Smoot-Hawley levels, with the attendant potential effects on the labor market. And we've already seen substantial slowing in the second quarter in terms of underlying private domestic final demand. Consumers look like they are feeling a little bit cautious. We can see that even in today's personal consumption expenditures data, which really was very modest growth. So yes, I do believe there's some risk that by trying to achieve those very aggressive tariff revenue goals, they really are putting a big dampener on what could be a very dynamic and exciting period in American growth.
Lyle, the Fed has that dual mandate, of course, of full employment and price stability. Do you think one is taking a precedent over the other these days within the Fed?
Well, I think we heard the chair talk about both sides of the dual mandate yesterday, risks to the upside potentially on inflation, and we see it in this morning's preferred Fed inflation gauge. You see those core goods going back up again after a long period where they had been coming down. But of course, you also see it in the labor market, where private hiring has really ground to a halt. Now, the labor market is in balance, as the chair told everyone yesterday multiple times. The unemployment rate has remained low, and that in part reflects the fact that labor demand is falling at the same time that labor supply is also being constricted on the immigration front. So it remains in balance, but I do worry about downside risks to employment.
Love Brainard, a young upstart economist up at Harvard. His name is, let me look here, Jason Furman. I think you may be familiar with Jason Furman. I love what he's doing on annualized analysis. Folks, out moments ago on Twitter from Professor Furman driving Ec-10 up at Harvard. 1 month core PCE, 3.1%. 3 months, 2.6%. 6 month annualized, 3.2%. 12 months, 2.9%. I'm sorry, Rick Mishkin and John B. Taylor out at Stanford, those guys may be policy, they're on different pages, they're on the same page. That core PCE inflation, Lyle, is too high, isn't it?
Well, the core PCE inflation is too high, and it's going, unfortunately, in the wrong direction. Yeah. That is the bind. So, you know, what we were seeing before a lot of the tariffs started to get imposed was actually finally services inflation were coming down, core goods had already come down, and so core inflation was trending down towards the Fed's target. Now it is detouring, with those core goods lifting it again. And core services actually in the last 2 months were a little stronger than we had previously seen. So it's moving in the wrong direction, and of course that's a concern.
And Paul, I can't emphasize enough the granularity of, these are full-time pros, heavyweights, analyzing the tariff impact, guessing out to Labor Day, guessing out to Christmas, guessing into next year. And the answer is nobody's talking disinflation.
Disinflation. How about the consumer, Lyle? How do you, given the backdrops that Tom just outlined here, how do you think the consumer is these days?
Well, we've got some insights into consumers and their feelings about both the economy currently and their expectations through some of the consumer surveys. And of course, a little bit less negative, but still quite negative relative to where it had been before the tariff agenda started rolling out. They seem to be worried that prices just are still too high. And of course, that now is creeping back into core goods, but housing has been a problem for a while. And that goes to the president's concerns, valid concerns, I think, that mortgage rates are quite high and that the housing market is frozen.